All right, traders, ever wondered what all those fluctuating numbers on your trading screen mean? Those numbers are more than just random data. They tell a story about market activity and trader sentiment. Well, let's dive right in and demystify one of the key metrics you need to know: trading volume in crypto and Forex markets. Understanding this can be a game changer for your trading strategy. First off, what exactly is trading volume? It's a fundamental concept that every trader should grasp. Trading volume represents the total amount of an asset bought or sold within a specific period. This could be over a minute, an hour, a day, or even longer. Think of it as a pulse check for market activity. Just like a heartbeat indicates the health of a person, trading volume indicates the health of a market. The higher the volume, the more active the market is. High volume often correlates with high liquidity, meaning you can buy or sell assets more easily. Now, let's break down the types of volume you'll encounter. Understanding these can help you make more informed trading decisions. Buy volume is all about the demand side of things. It shows how much of an asset is being purchased at any given time. It shows how much of an asset is being purchased. High buy volume can be a strong indicator of bullish sentiment in the market. When you see high buy volume, it usually means demand is skyrocketing and prices are likely to follow suit. This can be a signal to enter a long position. On the flip side, we have sell volume. This is equally important to understand. This measures how much of the asset is being sold. High sell volume can indicate bearish sentiment. High sell volume often indicates that sellers are offloading their positions, usually leading to a drop in prices. This can be a signal to consider shorting the asset or exiting a long position. So why does volume matter? Simple. It provides insights into market momentum and potential price movements. Volume helps you gauge market momentum. High volume markets have strong interest and can be more volatile, providing opportunities for quick gains or losses. High volume markets have strong interest and can be more volatile, providing opportunities for quick gains or losses. This volatility can be both a risk and an opportunity. Low volume markets, on the other hand, suggest stability or inactivity, which could mean fewer trading opportunities. However, they can also be less risky. To sum it up, understanding volume can give you a significant edge in making informed trading decisions. It helps you understand the market's pulse and anticipate potential price movements. By keeping an eye on volume, you can better navigate the ups and downs of the market. This knowledge can be a powerful tool in your trading arsenal. So, if you found this video helpful, don't forget to subscribe for more trading tips and insights. Thanks for watching. Stay tuned for more valuable content.